What is happening, investors? It is your boy Jack. I am not a financial advisor, and today we're going to be speaking about 4 dividend stocks that all have a dividend yield of 5 to 7+%. Some very juicy dividends in there. And what we're going to be doing in today's video is taking a look at the stock, take a look at their price, history, and performance over the last 5 years at a very minimum, really comparing how they have performed since the 2020 crashes. Take a look, obviously, at the overall dividend yield and the health of that dividend yield and the likelihood that that is going to continue going up. We are also going to be comparing some baseline stats against the S&P 500 when it comes to these companies, particularly when we speak about, things like forward PE ratios, to see if we can try and decipher whether these stocks are, undervalued, overvalued, relatively fairly valued. And we're also going to be taking a look at the financials for these companies, so that we're not just buying into them just because of this big dividend number. That has proven catastrophic in the past many times over. A high dividend yield does not necessarily mean a good or bad investment, but it's nice to look at some of these bigger dividend yield plays some of the time. Now, why do people invest in dividend stocks? The single biggest reason by an absolute mile is the power of compound interest. If you start off with $100 and you get a 4% dividend every year, that's only $104. But if you go 10 years into the future, that $100 can be worth a couple of hundred. And you can imagine then, if you are playing with thousands and then tens of thousands of dollars, just how quickly that can add up. You can see here that if you start off with only $100, you contribute an additional $100 every single year. You get an initial annual dividend yield of 4%, a 4% dividend increase per year, and 8% annual share price appreciation per year. That $100 with 100 every other year can turn into 6,500 over the span of 20 years, my friends. I mean, that is quite huge. And then obviously you bump up that annual contribution. I think anybody who's investing is doing more than that by a considerable amount. You can see just how quickly these things really can add up. So that is what we're going to be speaking about today. So just before we get into our first company of today, which is actually one we spoke about on this channel quite a few times in the past, Enterprise Product Partners, could I please ask you to hit that juicy like button nice and early for your boy. And if you end up enjoying today's content, subscribe for more, and I will be very happy to bring you more content such as this. Also, if you are interested in getting some free shares for yourself, if you sign up to Webull using my link that is in the pinned comment down below and deposit $100, you can get a lot of free shares valued up to tens of thousands of dollars. On average, you're still going to make quite a bit of money. I know people who have made hundreds just from signing up. You can then sell those shares and put them into any companies that you want. That could be the start of your dividend journey. So the first company we are going to be speaking about today, as I was just saying, is Enterprise Product Partners. So they are known as EPD. That is the ticker symbol right here. And you can actually see that their dividend yield is currently at 7.65%. So this is the biggest dividend yield we are going to be speaking about today. You can see it is a relatively large company with a market cap of $57 billion. Now, this company is approaching dividend king status as well. That is when a company has raised their dividend every year for 25 years in a row. And you can see that they are currently at 23 years. And you can see what that dividend history looks like just here. So as of right now, that dividend yield equates to about 50 cents per share on a quarterly basis. Back in 2000, that would have been 13 cents per share on a quarterly basis. This is the power of that compound interest, the power of staying invested and reinvesting your dividends into these styles of company. Now, their forward PE is currently at about 9.73. If we look at the S&P 500 PE, that is at about 17.8, and their dividend yield is only at about 1.73. So you could argue that from that metric alone, the company is currently at a relatively fair value. It's currently undervalued in many, many ways. And if we take a look at the stock chart, this here is the crash of 2020. You can see that they were trading around similar levels to where they are now before this crash happened. But since that crash, they have appreciated in value massively, from lows of $10.20 a share up to now currently 26, as high as 28 recently. Now, if we zoom out and look a little bit further back at that 5-year chart, you can see that they're only up about 2% all in all. Now, keep in mind, guys, this is during one of the biggest crashes we've ever seen, during a huge recession, during a time where a lot of stocks have lost a lot more value than this. And all the while, you have actually been receiving that 7+% dividend yield, which would mean your actual annualized returns here would have been considerably better than what you would be led to believe here. Also, if you have spent a lot of this 5 years, dollar cost averaging in, you're going to be up considerably more, considering you didn't buy most of your shares at that current $25 price, especially, if you were to buy some when they were in the lows, when they were sub 20s, you would have got a really nice annualized return with this company. One other relatively interesting thing here is you can see that the percentage of shares held by insiders at 32.73% with this company, a relatively high percent, and then 26.64% held by institutions. Profit margin is currently at 9.44% and an operating margin of 11.14% with a return on equity of 20.7%. It is very, very considerable. We can also see their quarterly earnings growth is actually at 38%, so they have been recovering very, very well out of the 2020 crashes. So quite a nice one, a very, very well-known one in the dividend game. One that, I'd still believe has many years of solid dividends and, at least stagnation, if not some sort of decent growth over the next 5 to 10 years. Now, the thing about EPD is they are an American midstream natural gas and crude oil pipeline company. So me, obviously, being a huge EV advocate, I would, be led to believe that maybe these won't be in my portfolio in 10 to 15 years time, but I do still think that for quite a while, they are going to perform relatively well. But that is EPD, and that is the biggest single dividend we're going to speak about today. Now, next up, our second biggest dividend of the day is actually Verizon, which a lot of you guys, again, will be very, very familiar with. You can see that their dividend yield, as of right now, is at 6.81%. And their consecutive years of dividend payments are at 22 years. Obviously huge. Now, their consecutive years of dividend growth is only at 18 years, so they're still a little bit away from that dividend king status, but you can see that that dividend is relatively safe, let's be honest. And again, it's approaching that 7% mark, which is absolutely fantastic for any company. Again, a very large company out here, 160 billion, and any of the US followers or subscribers out there are going to be well aware of who Verizon are. I hear mixed opinions about their actual services, but one thing is indisputable, they are an absolutely huge company. Now again, we look at that forward PE, which is at 8.26, again, would potentially lead you to believe it is undervalued in the grand scheme of things, in the grand scheme of the S&P 500, and with that huge dividend, it could be a relatively safe bet over the next few years. Now, before we get too far into this one, I would like to point out that they are down considerably. Now, this is one company that during the 2020 crash, yes, they did fall off quite heavily. Look, about $62 a share, down to 49. They recovered really nicely, but they have been on a downward spiral since about 2021. You can see some huge red days in here, some poor performances around the block, but again, that has brought their PE ratio down very, very low. And this is a company that's, let's be honest, is not going to disappear anywhere anytime soon. Now, I would personally say this one is a little bit on the higher risk side, even with that large dividend, just because they have been in a downward spiral. There is not a lot of investor or consumer confidence in the company as of this moment in time. But if you were to be building out a very large dividend portfolio, I do think that this, as a high dividend player, would be a decent company to have at least some percentage of your money in. And you look at the share percentage held by insiders here is only at 0.03%, but held by institutions is at an absolutely massive 64.24%. So quite a lot going on there. We see our profit margin at 15.5% and our operating margin at 24.2%, return on equity at 24.76%. So still some decent totals going on there. In regards to their balance sheet, we can see it is an absolutely huge one. Currently sitting on $379 billion plus worth of total assets. And then our total liabilities, net minority interest at 287 billion. So still a relatively nice position all in all, guys. And again, if we look at our income over the last few years, it has remained relatively steady both through the RONI and outside of it. The cost of revenue fairly similar as well. Not any huge growth here, but again, does that mean that they should be down at this price point? More than likely not, and that is why a lot of people may well argue that this company is undervalued at this time. And again, as part of a broader, diversified dividend portfolio, it could be worth picking up some shares at these prices that have not been seen for a very, very, very long time. We're speaking a decade. Now we are going to be taking a look at another very, very well-known company in there that has been through some absolutely huge ups and downs over the last couple of years. That is Walgreens, okay? Ticker symbol is WBA. Market cap is currently at $31 billion a share, but they are down an awful lot from all-time highs, and their dividend yield is currently sat at 5.4%. Now again, these are a dividend king, as you will see here. Consecutive years of dividend payments and growth, both sitting at 30 years. So a very considerable, very safe dividend for this company here. But again, you see just how messy this chart really is looking. They have had some really good runs post-Roni when, you know, retail began booming again, but they have been hit hard over the last year or so. So again, similar to Verizon in my opinion, one that, you know, might be worth picking up some shares at the current price point, but it's not looking as nice as some of the other high dividend plays out there. So again, if you are making a diversified portfolio, I wouldn't allocate too much to a company like these, but that dividend is still very, very nice to be seeing quarterly. And with that being said, you will see that their trailing PE is actually sub 6 and their forward PE is at 7.84, my friends. So again, it may be one where if it can come back out on top, you can see some really nice share price appreciation alongside that dividend. But if they continue this downward trend, you know, that 5.5% dividend is not going to cover future losses. So again, be careful with this one, but it's a huge name. It's a huge player. Market cap is currently at $30 billion as well. It's very large. We look at the percentage held by insiders at 17.19% and held by institutions at 61.7%. Operating margin is only at 1.56%, but that profit margin is negative 2.24%. And a terrible return on equity at 11.3%, despite huge revenues all the way up there at 132 billion. So again, this is one that is still in most, you know, large dividend portfolios, but I would personally be having it as a relatively smaller part of mine if I am to build one out in the near future, just because of, you know, general downward trends and general short-term uncertainties. But again, they can be the best time to buy for the long term if you can get them at the right price. Now, the balance sheet is still in a solid position and has been building relatively nicely since 2019. We can see 90 billion in total assets and just shy of 60 billion in total liabilities. So it's not terrible whatsoever. I don't think anybody expects Walgreens to be going out of business anytime soon, but they're in a very weird place for the short term at least. Now, our final stock for today is going to be another relatively well-known name, Phillip Morris International, nearly at $100 a share as of recording, a dividend yield of 5.2% and a market cap of 154 billion. Now, a little bit more expensive than the other stocks we've spoken about today at 16.86. But you can see that when we look at the stock's chart, from the bottom of their 2020 crashes at $55 a share, they are now up at 100 and have been up as high as 112. So they're one of the companies who actually has came out and, you know, performed a lot better than a lot of other companies and industries. So again, as a part of a diversified portfolio, you can spend a little bit more on some companies when it comes to our PE ratios and pick up some cheaper plays as well to make a nice well-rounded diversified portfolio. Now, their dividend hasn't been around as long as a lot of the other companies we spoke about, but still we are looking at 14 years of consistent dividend growth and payments for the company. So still very, very considerable. And if we have a look here, we can actually see that our revenues and gross profits are the highest they have been in a very, very long time. But they're not growing at an absolutely insane rate, to be completely honest. So again, it's one that, with a 5% dividend, if you can see some nice consistent growth over the last year, there is 7% over the last 5 years, 7.93% down. But to be fair, if this was taken only, you know, a couple of months later, it would actually be 25% in the green, plus all of those dividends, plus the compound interest from those dividends. You would have seen a really, really nice return. And if you were dollar cost averaging, again, this return over the 5 years would have looked so much better than what it's made out to be right here. If I was to have to rank all of these in orders, I would probably have EPG in first place on today's list, then Phillip Morris. Then, against somewhat better judgment, potentially I would have Walgreens just third place, just above Verizon. I think it's because the potential in share price appreciation Walgreens has is higher than Verizon, in my opinion, just because of, you know, how beat up it is right now. But if it was in regards to safety, Verizon would definitely be above Walgreens. But anyway, my friends, if you have watched this video all the way till the end, you are a true legend. I really do hope that you enjoyed. I know I haven't made any dividend related content in a while, but honestly, my plan now is to start slowly but surely building up a little bit of a dividend portfolio for myself. So I'm going to be making a lot more videos surrounding them. Don't worry if you're a regular viewer. We are still going to be covering EV big time. If you did watch this video all the way till the end, you, my friend, are a true legend. I really do appreciate you. If you could just hit that like button and subscribe for more content, that would help me out so much. I really would appreciate it. And of course, if you want those free stocks from Webull, all you got to do is hit that link in the pinned comment and deposit $100 once you sign up. It really is that simple. And again, with those free shares, you can sell them straight away and invest them into any stocks you want, whether that is dividend stocks, growth stocks, whatever you want. There's no rules. Anyway, my friends, I hope you all have a beautiful, blessed day. I'll see you in another video very soon. Peace.